if you are trying to raise money for your business, you are vulnerable because you're looking for money. What it means is that there's something that you want, and there's a certain kind of stimulus you will respond to. If somebody expresses interest in investing in your business, you're going to pay attention to that. So if you notice on social media, Instagram, Facebook, there are all sorts of scams running about very low interest rate loans or investing in your business without taking equity, all sorts of too good to be good kind of investments, right? And you will not believe it. There are many entrepreneurs, there are many business owners that have fallen for these scams. You find an investment opportunity and they are telling you that they're going to give you a zero interest loan. And then when you start the process, of course, it's a chain and it's a trap. You get to a certain level, by the time they've entrapped you, you end up being the person who loses money. And it's not just money you can lose. There are people who have lost IP, intellectual property. So some of these so-called investors who are really scammers, what they do is they masquerade as investors to get behind your business and understand your either your trademark secrets or your business secrets or your intellectual property, all sorts of things like that. So that's one way they can take advantage of you. The second way they can take advantage of you is when you get to the stage that's called due diligence. So the way the investment process works is most investors, particularly the formal and institutional investors, they are not just going to give you money. They're going to want to understand or verify many of the details that you've given them. So for example, if you're trying to raise money, you tell the investor that, last year we made $100,000 in sales. The year before we made $70,000. When you're at the pitching stage, you can make promises, you can tout numbers. But when you get to the due diligence phase, investors want to see facts. And that's when they want to look at your books, they want to see your bank statements, they want to see evidence, records, and things like that. But what these scammers do is they tell you need to pay some fee for due diligence or for insurance or for some notary or something. And you're trying to raise $100,000, but they tell you need to pay $1,500 or $2,000 for this small process thing. And that's how they get you, right? So it's very important that when you're trying to raise money, you do a background check on the person or the organization that is promising to give you money. One red flag, if you cannot find them online, and they claim to be an institutional investor, or they find you online, but they don't have a presence online, that's a red flag. That is one red flag. A proper investor should not ask you for any sum of money before you get the money. If there is any money to be paid, so let me give you a couple of instances. Part of the due diligence process may involve lawyers and accountants, and somebody has to pay for those services. So sometimes the investor might pay for it because it is a service that is done to reduce the risk of the investment in your business. Sometimes the investor might say that the two of you will share the costs of the due diligence. In that case, if you are going to raise $100,000 and your own share of bearing the costs is $1,000, what you get from the investor when the deal is done is $99,000, but you don't pay any money in advance. Instead, the investor is supposed to deduct it from their investment. So it's not generally good practice if you have to pay money to get an investment.